Good afternoon, Asia, and good morning in Europe. Welcome to the AVPN webinar on impact measurement, management, and exit. My name is Gloria Schramm-Friedenberg, and I'm at the Hong Kong and South China Director AVPN. And I would like to thank you all for joining us in the discussion today. AVPN's mission is to move more capital towards impact, an important task in today's world. Increasingly, investors are moving capital towards value creation for all stakeholders, not just shareholders, seeking positive returns that are not only financial, but also environmental and social. Against this backdrop, various impact measurement metrics have been developed and adopted, allowing investors to monitor and report their investments under standardized impact measurement and framework. At the same time, it has become clear that we must act beyond measuring output to identify best practices for how impact investors can better manage their portfolios, incorporating a well-intended and measured approach to impact throughout the investment process. Today, we're grateful to be joined by two very esteemed speakers from the leading privately held impact investment firms, Mr. Melvin Teo and Mr. Paul Haley. Melvin is the Vice President and a founding member at QUADRIA Capital. He has over 12 years of private equity and strategic consulting experiences. Prior to QUADRIA Capital, he was an alternative investment and a strategy consultant working on projects across industries with a focus on healthcare. Paul is head of impact at Responsibly Investments and has authored various publications. At Responsibly, Paul coordinates and carries out impact measurement of development investment across more than 70 emerging and frontier markets, presenting the impact framework and its contribution to the Sustainable Development Goal, the SDGs. Let's turn over to Mervin Teo to start our first segment of our webinar. Over to you, Mervin.
Thanks, Gloria, for having me. Pleasure to be here, and thanks everyone for joining the webinar today. My name is Mervin. I'm a VP at QUADRIA Capital. So I wanted to spend maybe the next 10 minutes to share our journey of impact investing and measurement. We've been around for not too long, about 10 years. So, our journey is, albeit a fast-growing one, is also a relatively young one. So hopefully we'll be able to share some of our experiences as you think through your journey in impact investing and measurement. So maybe just on the next slide, on slide 2, just at a high level of who we are and how we started. I think 10 years ago when I joined QUADRIA as well, we saw that there was a shifting of the healthcare industry shifting very rapidly from the west to the east, and we felt that there was a unique opportunity to invest in emerging Asia healthcare, not just for financial returns, which is compelling given the growth, but also the ability and the opportunity to create significant social impact for the betterment of local communities. So that was the fundamental thesis of why we started and why we felt there was a compelling opportunity of profit with purpose. So if you turn to the next page, so I mentioned this earlier. I think we saw about 10 years ago that the center of gravity for healthcare was shifting very rapidly from the west to the east. So just a sense of how big the sector is. So the Asian healthcare market is worth $4.2 trillion today. So that is the combined US and Europe healthcare market today. So that's just the size of the market. And I think what's more important is what's driving the growth of the healthcare sector in Asia, unfortunately, is kind of secular mega trends. So it's not financial trends, but things like chronic disease burden, the aging population, rising affluence. So these are mega trends that we see shifting the sector very quickly. And a large part of healthcare in Asia is also privately funded, unlike Europe and US, where a lot of it is coming from the government. Unfortunately, in Asia, a lot is privately funded and out-of-pocket funded. So people actually pay for healthcare out of their pockets. So this was probably one of the key reasons why we felt that there's a real opportunity for us to create affordable healthcare in a region where there is lack of supply and where the need is most needed. So if you turn to the next page, on page 4, despite the huge growth opportunity we saw, we quickly realized as well there were significant barriers to assessing this growth. So if you look at some of the statistics on this page, shockingly, 2.6 billion people in Asia earn less than $3 per day, and over 1 billion people will never see a doctor in their entire lifetime. So, these are just very stark, very sad truths that we are faced with here in Asia. And if you look at the infrastructure and the current infrastructure of healthcare in the region, there's less than one hospital bed and doctor per 1,000 people, compared to a global average of 5 beds and 3 doctors in most parts of this world. And the amount of capital that's required to take Asian healthcare to a level that is acceptable or level of global standards, that's estimated to be around $60 billion of investments required every year to take Asia from where it is today to where it needs to be. So, and that is why I think, we saw there was fast growth. There was a huge undersupply for healthcare. And, when we started our journey 10 years ago, we're thankful that if you go on the next page 5, we have been able to invest in over 20 healthcare companies in the region. Today, we manage over 2,500 hospital beds. We employ over 2,600 doctors and clinicians, and we have served over 17 million patients across the region. So how do we think about impact at Quadria? I think we look at it purely from a healthcare lens, given that we're a healthcare investor. And there are 4 key areas that we are focused on page 6. That is accessibility. So, creating access to healthcare. And as I mentioned earlier, there are not enough hospital beds, not enough doctors. So how can we facilitate private capital towards increasing infrastructure, whether it's hospital beds, whether it's increasing clinical training for doctors, really increasing access of healthcare to the lower income populations. Next is on affordability. The unfortunate truth in Asia is that 90% of healthcare spend is actually paid out of pocket. And healthcare expense is one of the main reasons that leads someone to bankruptcy, right? Is because, someone in the family gets hit by a medical condition. And that's one of the key reasons that leads to bankruptcy actually in emerging Asia. And also, if you look at the earnings that 2.6 billion people actually live below $2 per day. So the kind of dynamics of ability to pay is actually very important. And one of the things that we keep trying to do as we think through companies that we invest in is how do we provide not just accessible healthcare, but also do it in a way that's affordable, lowering the cost of healthcare. And I'll share an example towards the end on how we do it. The third key pillar we look at impact is awareness. So this is all about healthcare literacy. How do you increase awareness and diagnostics of patients to make sure that they actually get diagnosed early and they can actually get treated early. And last is on quality. So increasing the quality standards of healthcare in the companies that we invest in. So if we turn to page 7, actually, I want to go to the case studies where I think actually is a bit more interesting. So on page 7, we actually talk about the SDG. So when we looked at the 4 key pillars of impact, we actually matched this with the social development goals. And we think that these are the areas that not just we are very focused on, but our investors are very focused on as well. And if you turn to the next page 8, I just want to share, our approach towards impact on page 8, please. So how we do it is in 4 steps. So I think we take a aligned approach when we look at impact. So in the pre-investment stage, we actually conduct very deep due diligence that we work with third-party consultants to help us look through the impact and ESG performance benchmarks. We then look at, during the time of investment, what is the action plans? What are the specific targets that we want to achieve in each company? We then monitor that process every year through a GASTROENTEROLOGY certification and ESG review. And I think what's most important is at the exit, we actually work with companies to make sure that there's a governance framework in place so that even after we exit, that the impact intent is maintained in these companies. So it's a holistic approach that we take across the investment life cycle to ensure that impact is measured, maintained, and even at exit, it continues to stay with the company. And if you go to the next page on page 9, this is something we created when we started thinking about impact. It's the impact circle. So as I mentioned, there are 4 key pillars on access, affordability, quality, and awareness. And what we do before we invest in any company is to look at, what is the company able to achieve from an impact perspective? Is it creating access? Is it creating affordability? So different companies will achieve different aspects of the impact circle differently, and we'll score the companies basically based on the 4 areas. And that's how we basically track the impact. So each company is different, and maybe I'll share an example in the appendix when I come to it. So if you go to slide 17, I just want to share an example of, I think a real example is probably the best way to illustrate this. So the Asian Institute of Gastroenterology is a company we invested in about 2 years ago. When we invested in the hospital, it was a 300-bed hospital in Hyderabad, focused only on gastric sciences. And the key thesis there is to help them scale out access of healthcare. And today, when we invested, was 300 beds. Today, it's a 1,000 hospital bed gastric sciences hospital in Hyderabad. And I'm also pleased to say that earlier this year, we managed to suture up a partnership with the Mayo Hospital, and it's been rebranded the AIG Mayo Hospital, where we could provide very high quality gastric care at the lowest possible cost. And the key things that we track at this hospital, if you turn to the next page, is 1, access. How many patients are we actually touching annually? And how many procedures that we are actually conducting globally, how many procedures we're actually conducting annually. So the amount of treatments that we're actually providing in the sector. 2, I think is equally important, is affordability. So given the scale of a hospital like AIG that's only focused on gastric sciences in big scale, we were actually able to lower the cost of healthcare significantly. Just to give you a sense of it, we conduct endoscopic procedures for $20 per procedure, compared to in the US where people will pay $2,000-$3,000, and we charge $30 for colonoscopy. So being able to drive scale, build clinical expertise, and lower the cost of healthcare through volumes has enabled us to actually provide very high quality, affordable care at a fraction of the cost. The third piece was on quality. So in AIG, the quality that we're focused on is in making sure that we not just provide best-in-class care in India, but also train doctors globally. So we have trained over 600 doctors globally that have gone back to Vietnam, to Thailand, to Indonesia, to Philippines to actually practice, and through their expertise and their learnings at AIG, to actually pollinate and share knowledge in their local communities and local doctors. So not just within India, but also thinking of how can we upskill clinicians' expertise throughout the rest of Asia. And the last is on awareness. Through our partnership with the Mayo Clinic, we were actually able to get access to their research and done a lot of joint research with them, and was able to bring the benefit of a global institution like Mayo Clinic to the benefit of the local populations in India. So that was the case study I wanted to share, but I have 2 other case studies, but I wish I had a bit more time. But maybe I'll turn over to you, Gloria, and I'll pause right here. Gloria, I think you're on mute.
Yeah, thank you so much, Marvin, for the insight and case study. Sorry, I was on mute. Let's move over to Paul now to discuss responsibilities, impact, investment strategy, and management. Paul?
Hi there. Well, thank you very much, and thank you to Mervyn for an excellent presentation, and of course, thank you to Gloria and everyone at AVPN for giving us a bit of time here today. So my name is Paul Haley. I am the Head of Impact at Responsibly Investments, I think the idea here is that I'm going to try and relatively briefly outline what it is we do, and a little bit of the landscape that we see when it comes to impact investing, and finally just talk a little bit about our approach to impact management and measurement. So perhaps if we go on to if we go on to slide 4, which is just about responsibility. I won't dwell on this too long. I suspect that if you've joined this webinar, there is a reasonable chance that you might know who we are already. We have $3.5 billion assets under management. Most of what we do is private debt rather than private equity, but we only do private debt and private equity, nothing listed, and we only invest in developing markets. And yes, we're invested in around about 300 different companies, and we have a particularly strong presence in the Asia Pacific region due to our presence in Mumbai, Hong Kong, and Bangkok. If we move on to the next slide. So our investment is primarily focused around these three topics, which are sustainable food, which is to say investing across the agricultural value chain, in producers, processors, etc. Financial inclusion, which is primarily microfinance and SME finance institutions that we finance or where we invest in them, and climate finance, which is either lending to local financial institutions so that they in turn can make green loans, often to SME banks, or investing directly in renewable energy projects, either on-grid or off-grid. So perhaps if we move on to the next slide. So this is just a very quick overview of how we see the landscape today, because I think it's important to provide a little bit of context in terms of what we're seeing. So on the next slide, you're able to see just now these aren't our numbers, I should say, before it seems I'm taking the credit for someone else. This is a report that came out last month from Symbiotics, just to talk about. I think everyone's got used to the idea of, okay, sustainable investment is the thing, and it's true that according to them, it accounts for around about $31 trillion. Impact investing nonetheless remains, just a share of that, basically. So impact investing overall is $715 billion. If you look at the amount of that is going only towards private debt and private equity, which is the space that both QUADRIA and Responsibility play in, it's $272 billion. Then if you focus down even further into emerging market and frontier markets, it's 159 billion. And you can see the direction this is going in. It remains one part of what is a very broad and diverse investment universe, which among other things means that it can be a little bit difficult to deal with the very varying expectations of investors. Now, one thing that I didn't mention in the previous slides is that Responsibility has an investor base that is split between development finance agencies, between institutional investors, which, as we all know, incorporates a very wide variety of investors, and finally, retail investors. One of our products is available towards retail investors, which means that whatever impact framework we have, it has to be one that is flexible. As you've seen, we cover a lot of different business models. It also has, in terms of where we invest, but equally it has to be one that is, frankly speaking, both credible to, say, the development finance agencies, and has to be easily understood by investors who maybe aren't necessarily entirely sophisticated on the subject. Now, if we move on to the next slide, therefore, what we are seeing also when it comes to the question of impact is these four trends. These are what we feel are four of the trends that are really having an impact on our industry. So on one level, you have industry initiatives like the operating principles for impact management, the so-called IFC principles, the impact management project. You also have the rise of blended finance, which means increasing, I think, the days of private-only products, that's starting to diminish a little bit. You're seeing development finance agencies taking an increasing role in many products. You have the role of EU regulation, of course, as well, which is setting out in the European Union increasing demands on how you define sustainable finance. And then you have the threat posed by impact washing, which means that when you are a specialist impact investor like us, you're under more pressure to really differentiate yourself and really accentuate the credibility of your impact approach. And all of this leads to the same point, however, which is that robust and credible impact in ESG management is an essential element of what you do. And that last point here of management, not just measurement, is an important one. The last few years, I think we've really seen an evolution, even in our specialized industry, away from the idea of simple ex-post measurement towards actual impact management, which I think Mervyn laid out very well within his within the system that he demonstrated for QUADRIA. The idea that impact is something that is present right the way through the investment process. So if we move on to the next slide. So, and then the slide after this, my apologies. So what is the approach of responsibility? Now, as I mentioned before, responsibility is present across a lot of different sectors and a lot of different business models and counterparties. And we have around about 15 different products, some of which are debt only, private debt only, some private equity, most are in this shape of funds, but there are a couple that are in the shape of bonds, for example. And the approach that we take is to say, well, look, if you take one of our products, every single one of our products aims to contribute, to have an impact, to contribute to the SDGs through one of three ways. And these three ways that we very grandly call impact strategies. Now here, for example, you're seeing an example of the three impact strategies for one of our products dedicated towards financial inclusion, which means that we invest in microfinance institutions and SME banks. And those three areas are provide access to finance for low-income households. The second is creating jobs by supporting small businesses. And the third one is boosting financial sector development, which is more of a long-term structural aim that we aim to affect. So the idea is that, yes, these are the three areas where we will aim to look at and demonstrate our impact. This is what we aim to do when we go into an investment. This is what we aim to achieve with our fund. So if we move on to the next slide, for example. Now, this is going to look like a very detailed slide, and my apologies if you feel you're drowning in text when you're looking at this. But the idea is that every one of those three strategies, we aim to be able to break that down via the 5 dimensions created by the Impact Management Project. And for those of you who aren't familiar with this initiative, the Impact Management Project is a program, an initiative created by a group of development finance institutions, development agencies, together with others, various NGOs and major investors in the space. And the idea is to say, look, anytime someone comes up to you and says, here is my impact strategy, you should be able to break that down via these 5 dimensions. You should be saying, okay, if you say this is what you're doing, well, what problem are you trying to address? Who will benefit? How big is your impact? And what is your contribution to that impact? And what is the risk that you either don't achieve it or that actually you have a negative effect? And so we have an impact concept, if you will, for each of, where we break down the 3 strategies for across each of those 5 dimensions. Furthermore, in terms of our impact, in terms of our process, our investment process and the role impact takes, our investments, and this is something we're actually in the process still of rolling out across a couple of our business lines, we create a score, an impact score. And this impact score is based on metrics across each of these dimensions for each of the 3 strategies. Now, in the case of a debt investment, what that will mean is that we will say, okay, we have created an impact score for the extent to which an investment fulfills these 3 strategies. Now, if we feel that impact score is not at a sufficiently high level for any of those strategies, which is to say, if the investment just doesn't contribute to one of the 3 impact strategies that we claim is at the heart of this product, then it's effectively not viable as for investment. Now, this I think is a slightly more top-down and automated approach than what Mervyn was laying out. And the reason for that is that the example I'm giving you here is for one of our larger private debt products, where it is, I think there is, the maturity of the investments is a little bit shorter, where you have, I would imagine, more counterparties. And so that there, in this instance, we need to have an approach that is maybe a little bit less bespoke and a little bit less detailed, and where we can deal with the fact that there are a lot of different investments coming through. On the equity side, it's a different story, and I think there our approach would mirror a little bit more what Mervyn is laid out when it came to Quadria. So if we go on to the next slide. Now, of course, you will have noticed that one of the dimensions that we listed there was the dimension of contribution. And I think this is one where the idea of contribution or additionality, intentionality and additionality are 2 of those words that seem as if they're made up words for our industry. I'm not sure I ever encountered them before I started working in this space, but they are 2 of the most key words. Intentionality, the idea that you have a clear idea of what you're seeking to do when you invest. That is something which, as I mentioned before, we try and address via our impact scoring. Additionality, the idea of contribution, I think is quite a difficult one, can be quite a difficult one to set out. In our case, here I'm giving you perhaps the easiest example here, which is maybe a little bit of a cop-out, because when you're providing debt financing to a microfinance institution or an SME bank, of course, your primary element there, your primary impact is that you are helping them to increase their loan portfolio and to scale up what is already a very impactful business model. So hence the fact that we will focus quite heavily on their impact at the outset, on the concept of intentionality, because there you are scaling up a business model that is already quite impactful. On the equity side, I think there's a little bit more scope for actually improving the intensity of impact. It also means that to a certain extent, we can quite easily translate what we are doing in terms of the number of loans that we seek to achieve. So here you can see an overview of, okay, this is the number of, and it's a little bit arbitrary in the sense of if you take a $1 million invested, you would reach 492 microfinance institutions, 492 microfinance clients, of which on average 74% will be female, and 17 SMEs. So this would be the number of loans that you would seek to achieve with that amount, that we would achieve with that amount of money. But this is, I think, a very simplistic overview, and it's worth pointing out that there are other ways that we can have an impact in terms of direct contribution. So beyond translating that directly into an impact, we can look at elements like, for example, are we providing local currency funding, which is even harder for many of these institutions to find? Are we providing technical assistance in addition to this? Is this a long-term investee? So is this a relationship that we have sustained over many years and where we've helped that organization to evolve and in some cases achieve a regulatory transformation? So there are a lot of different ways that this can occur on this side of things. And if we go on to the next slide, please. So I think that what we were trying to do here is give you a little bit of a conceptual overview of how our system works. And my apologies again, I would echo Mervyn in saying that I would quite happily talk about this for quite some significant longer period of time. In terms of giving a specific example of how this can work, I guess what I would like to do just very quickly is talk about one of our other investee companies, and unfortunately we don't have a slide here, on the agricultural side, just to change things up a bit, having been so dominated by finance so far. So in this instance, and again, I think this illustrates the difficulty of trying to nail down exactly what is impact, what is core impact, what is your contribution. One example I can give is of an agricultural cooperative where we've been invested for 8 years. It's operating in a market where there's very, very little funding in Southeast Asia. It's one of the leading agricultural cooperatives in that country, if not the region. And it is an organization where we have been providing this, what seems to be relatively simple lending in terms of short-term financing on a seasonal basis. So we're effectively giving them export finance. But this export finance allows them to stabilize, it allows them to plan for the future, and ultimately it allows them to to afford training and other skills training and inputs for the smallholder farmers, allowing them to increase their output in terms of yields while still maintaining a sustainable approach. On an even more significant level, this is an organization that has then taken the decision to provide free healthcare insurance to all of its members and their families, which means that as well as being an agricultural cooperative, it is now the second biggest healthcare provider within that particular market. So this slightly rushed and overview is to give you an example of, look, this is the way in which we can take a small amount of working capital finance, invest it in an agricultural cooperative, have a direct impact on what we consider to be the impact priorities when it comes to agriculture, which is to say boosting healthy and sustainable agriculture, helping smallholder farmers, but at the same time also have a ripple effect that goes beyond that in terms of the broader benefits of the overall community. And I will stop here. I'm sure I've spoken for far too long.
Thank you, Paul. Really appreciate it. We have one question actually we want to ask you. We have a lot of questions in the audience already we're sipping through. So I'm going to go to Mervyn first and then come back to you. Each have 1 minute to answer. So in deal structuring, what are the concrete steps that impact investors can take? We have about 40% there are startups, sort of brand new impact investor in the audience. To take to align value, create value in order to balance the financial and the social returns in this day and age after the pandemic, assuming they're just starting out. Mervyn?
Yeah, sure. Thanks for that, Gloria. I think for us although we're an impact investor, half of our investors are actually impact, and half of them are actually financial institutional investors. So, they won't give you a free pass just because you're doing impact for low return, right? They will expect you to deliver the best returns, 25-30% IRR, and on top of that, you got to deliver the impact. So, I think, at least from our perspective, the concept of profit and purpose is not one that is exclusive. In fact, we think that it can actually go hand in hand. And I think that's just something that, is a mindset change that, some people might think, if you're doing impact, then you got to give something, you got to charge lower prices, you're probably less profitable. But I think how we have done that quite successfully in our businesses is through a few business models. So for example, we're very focused on scale. For example, a 1,000-bed hospital, AIG, is all about driving volumes and throughput and making sure that your doctors, because they are so proficient in the way they manage the cases, they see a lot of cases, they get more proficient, and it actually lowers the cost of healthcare, which is very counterintuitive. To give you a sense of it, our hospital in AIG treats probably the poorest patients in the world, right? Charging $20 to $30 for a scope, but yet it generates a 40% EBITDA margin. If you compare that to a large hospital like HCA in the US, they are doing 20% EBITDA margins, and they're serving the richest patients. So it's just counterintuitive in the way that it actually works out. So I think just having the mindset that you can build a profitable business while still delivering impact, I think is important. And to your first question on how do you structure deals, I think one is obviously alignment with the promoter is very important. I think one of the biggest risks we see doing deals in Asia is actually counterparty risk. It's not so much about the business. Business, you can always diligence it, but it's actually knowing about the founder and whether you have shared values and alignment on impact. Right? I think that's the most important thing. And structuring in documentation, there are many ways to do it. There are many performance standards out there that you can adhere to, and you can try and incorporate in your agreements with the companies on how you would like certain matrices being measured, how you like it being reported, and how often you want it reported. I think those are things you can do. But I think ultimately it's really getting comfortable with the promoter, making sure that your values are aligned and you care about the same things that he cares about. I think that's more important.
I think, Mervyn, you are almost citing Hippocrates' oath to me, benevolent and veracity. I think I remember some of it. So I'm going to pause, see what you want to come back to that about what Mervyn just said in deal structuring. What are the concrete steps in your sector? Paul?
Well, it's a good question. Again, if you look at where we're involved and also the types of deals that we're doing, both on the debt and the equity side, I mean, our approach then does have to vary quite a lot. So as I mentioned before, when it comes to private debt, I think from an impact perspective, the most important thing is to have that question of intentionality addressed, from the get-go. As I said, whether it's a microfinance institution or an agricultural cooperative or whatever else, the important thing is to be very clear on the fact that, look, generally with debt, you are scaling up a business model that is already impactful. So hence the fact that we need to be very focused on what this is. We need to be clear within, if need be, within the covenants of the loan that, we have certain expectations. And then after that, we just need to make sure that we are tracking development over the period of the maturity of the deal. On the equity side, it is a different setup, and there, obviously we have a lot more scope to be involved and to improve the intensity of the organization's impact. And I think there again, it's what Mervyn's point about aligning incentives and performance, incentives and impact is, I think, quite a good one. And I would argue it can actually work in the other direction, in the sense that we've been able to work with some of our investees towards a point where we say, look, if you improve your impact systems, not only does it improve your performance overall as an organization, but also it will allow you to attract financing from organizations that and investors that are themselves more impact oriented. So there are, some of our investees, they're organizations where they're aware of this already. They know how this is going on. But there are other investee companies where we're invested, where we are the first impact investor to have turned up, even in this day and age. And so I think there is a certain amount of eye-opening there as far as they're concerned, in terms of trying to integrate that into their approach and to try and engage with the organization in this direction as well.
Thank you, Paul. We have a... Oh, go ahead.
Sorry, I would just say one other kind of element that's maybe between the two. Sorry, just to finish that thought. There are products where we're involved, which are on the debt side, however, but where we can still engage with the investee, and that's typically with the use of technical assistance. So if we take the example of one of our funds on the climate finance side, we have provided long-term debt financing to institutions for them to provide green loans to local companies. However, again, in many cases, these companies, this is the first time they've ever done a product like this. It's the first time anyone in that market has done it. So in that instance, we're able to actually help them to set up the green lending program. And that's where I think it can kind of fall between the two. Anyway, I'm sorry, please go on.
No. We have many questions pouring in. So this one, I think it's towards both of you, but I'm going to ask Mervyn first, see what he thinks, because these questions are clearly not really directed at each of your sector per se. So Mervyn, what are the main requirements for the project to attract investment from the fund? Since you are, you're at the front side for a long time. Paul is the brain guy,
Yeah, I mean, look, I think you have to first figure out, what kind of investors will be interested in your kind of company. Obviously, there are a wide variety of investors who invest in different with different mandates, right? So if depending on what kind of company you are, I think the first step is to figure out who are the investors you should go talk to. I think that's the important first step. So every investor will look at investments differently, but for us, we're a growth equity fund. Like I mentioned, half of our investors are, the financial institutional type investors, and the other half is impact. So for us, both being able to generate IRRs and return is important, as well as the ability to demonstrate some tangible social outcomes. I think that's equally important for us. So that's what makes an attractive investment for us. And obviously, if you go to the nuts and bolts of corporate finance, is things to do with for projections, your cash flows, it's a whole gamut of corporate finance. But I will not go into that. But I think if you have a good business and you can find a right value proposition that you can communicate succinctly, I think you then have to just identify who are the investor pools, and have they invested in similar companies like yours, and then go talk to them. I think that's probably how I would do it. But it's a hard question to answer, I guess, on what makes you a attractive investment.
Paul, you want to come back to that? Paul, you there?
Sorry, my apologies. In terms of the eligibility criteria, you would mean in terms of how we would go about it? Well, obviously, my area is more on the impact side. And again, it's about ensuring that we have this impact scoring system. It is in place to analyze this. I think, again, though, I would choose to focus on the fact that when it comes to on the debt side of things, it's about looking about where the organization is right now and how we're helping to scale it up. On the equity side, what we will be looking for is impact potential. And so that will be a question of applying, I think Mervyn alluded to it just before, looking at projections and trying to understand what is part of the organization's business plan. And that's not just a question of practicalities. Yes, as an equity investor or a debt investor, you do have access to this data. It's more a question of what makes sense conceptually and what you can implement. Beyond that, though, on the financial side, it's I think we will, depending on the asset class we're involved in or the sector we're involved in, we will have different criteria just in terms of typically we're not as much on the venture side, so we're looking more for organizations that are a little bit more established, although in the case of some of our equity investments, that can be a bit different. And of course, we will have minimum expectations in terms of things like, for example, in the case of a financial institution, we will want to be sure that they are actually doing microfinance and SME finance. So we will look also beyond the impact score, we will look at questions of what is their average loan size, to what extent is their portfolio dedicated towards things like consumer lending, which in our consideration is not something that is as impactful. So all of this will be incorporated into our approach and what we're looking at.
You do pre-screen them for all the deals you go in beforehand.
Yes, absolutely.
Thank you. I'm trying to simplify for the viewers because we're 40+% newcomers.
Someone should simplify me.
No, it's fine. It's fine. So there's this question. I think it could be from the 40%, could be from someone into intermediate range. I'll go to Paul first because I know you love this. How should an investment firm go about designing their own impact measurement framework? Should we align solely with the SDG at a high level and deep dive into other metrics? Then we'll go to Mervyn of that. You go first.
Well, look, I think the SDGs are great, and I think they are, it's the quote of the day, SDGs are great. The SDGs are great, but it's worth pointing out they are an aim for all of us. They're a societal aim. So it's not just for investors, it's an aim that for governments to go towards, for civil society to move towards, for consumers to move towards. So it's a good overall end point to go for. But I think in terms of what we do, you can't necessarily have them as the fundamental element of your framework, in the sense that yes, it's the end point, but they are quite general, to be blunt with it. Then there are other processes and approaches. We mentioned before the impact management project, the GINS IRIS Plus approach, which all makes sense. But I think the most fundamental point here that is really, really important here is just to have a coherent approach throughout all of what you're doing. And again, I don't want to embarrass Mervyn, but what I liked about the QUADRIA presentation there is a very clear thread throughout this of, look, this is our core concept. This is the impact, strategy and framework that we're aiming for. And this is what I was trying to demonstrate as well with our 3 strategies. These are the 3 strategies. From the outset, when we go into the investment, we know what we are trying to achieve. So the idea, I think most important, is not to try and retrofit an impact strategy onto an existing approach on the financial side, but to have that at the core of it and then manage it right the way through. So I think as long as you take that approach, afterwards, in terms of exactly which methodology out there you apply, I don't think it's as important as just making sure that that coherent strategy is clear right the way through throughout the investment process.
Mervyn?
Yeah, no, I echo a lot of what Paul mentioned. I think what I would add is, I think as you think about designing your own framework, it's also important to ask yourself and your stakeholders what's important for you, right? Because there could be a million impact outcomes that you want to achieve, but obviously you can't achieve a million of them. So you've got to figure out what's important for the firm, what's important for your key stakeholders, and then based on the broad framework of what you want to achieve, then drill down to look, what are the actual outcomes I want to track, and then work with the companies to track these. And I think that's how at least we have done it, and we have landed on the 4 pillars of access, affordability, awareness, and quality. So I think that's probably a way to think about is what's really important for you and what is it that you really want to impact, and then work from there.
Thank you, Mervyn. I have a few other questions about digital currency and also currency hedge. The question's a little bit blurry, so I figure you guys can sort of take that away about currency hedge on your funds or US dollars. Obviously, your investing area that are not US dollars. Would you comment on that first, and then we'll go to Paul, and then about impact of digital currency on social banking. Go ahead, guys.
Sure. So, well, not an expert in currency. What's that?
It's the future.
Yeah, it's the future. But I can comment on hedging. So, look, the reality is, given that we're a US dollar fund and we invest in emerging Asia. The reality is, the cost of hedging is just prohibitive, and we're kind of 3 to 5 year investors. So imagine trying to hedge a position for 3 to 5 years is probably wipe out your returns, whatever you make, right? So how we kind of think about the currency depreciation volatility is that we underwrite it at the time of investment. So we typically assume some form of depreciation over the time of our holding period, and then we reflect that in our valuation. So yeah, the unfortunate truth is, the cost of hedging is just way too high at this point. So we don't really, the only hedge we do is very short-term hedge. For example, we're closing a transaction and we probably hedge for 2 months. a month. I mean, that's possible, but as an investment strategy, we don't.
In the private equity sector, yes. So Paul, you guys are majority debt fund. Would you comment on that impact of the hedging and also the impact of digital currency? Paul?
Sure. Well, on the debt side, yes, I mean, because it's a fixed term transaction, we're in a better position in terms of creating a hedge, but I would still, obviously the cost of hedging, typically it's rather difficult to go out there and find a dollar tenge swap, for over 3 years. Nonetheless, actually, we are lucky in the sense that there are facilities out there specifically tailored towards impact investors. There's a couple of facilities that have been created by various DFIs specifically to move towards that. So they do exist, but the cost of hedging is expensive. But on the other hand, this is what is required in order to reassure our investors and to make them realize that, look, fundamentally what you are investing in and what you are, looking towards is the performance of the institution and our investment processes and creating an impact. This isn't a currency fund. So I think it is an important element. It should be said, obviously, we're aware of the broader economic implications of this as well. If your end user ultimately is a microfinance borrower, in a rural part of Tajikistan or Uganda, you don't want them taking the currency risk on their shoulders. So we have to be very much aware of this. Nonetheless, there is some of our portfolio where the end user is going to use dollars. And that will either be because they're a small business and maybe they're doing cross-border business, or ultimately in some cases it's because the underlying economy has a currency that is pegged to the dollar, or even where on a practical level the economy is effectively dollarized. So it does happen, and we do have that instance. And where we do feel that local currency funding is necessary, then we try and provide it. But as I mentioned, again, this is quite a good source of additionality. There are, in many of these markets, there isn't much international funding coming in the first place. International funding in local currency is a hard thing to come by. So we view it as a good opportunity to make a contribution as well.
Thank you, Paul. I guess in 17 years, you guys already did your currency mapping and the pegging in the region you invest in. So you're pretty much covered from that end. Is that correct?
That is correct. But at the same time, you'd be surprised. I think we've been pretty lucky, but you do see financial institutions, even in these countries, where I think perhaps they can still be caught by surprise.
Right.
Just because it's worth pointing out that just because a currency's been pegged to the dollar for say 5 or 10 years, it doesn't mean it's going to be pegged to the dollar for the next 5 or 10 years.
Right.
Changes do still happen.
That's a very good point for all of us to actually think about. Yeah. So Mervyn, this is the last question for both of you. I'm going to ask Mervyn first, because I know we talked about this in our prep sessions. What are the best practices for impact investors and investee companies to collaborate to develop a sustainable exit strategy in your respective sectors? Mervyn, I'll let you go first.
Yeah, so on the exits, I mean, we think about it actually right at the onset. Is kind of counterintuitive, but before we make any investment, we always think about the exit right at the start. So in that sense, in all the companies that we work with, we always build out a 5-year plan towards the exit. And it's not just the financial outcomes that we want to achieve, but also the impact, the outcomes that we want to achieve over the next 5 years. And we track that every year. And I think one of the things that we try to do increasingly more is we understand that, at some point when we as in QUADRIA exit the business, how do we ensure that the companies continue to maintain the impact ethos within the company and they continue to do what they have been doing. So I think it has a lot to do with education, I think, at the start. A lot of businesses in Asia are family owned, so they're a bit behind the curve maybe on impact measurement, or maybe it's not as important for them in the past. But I mean, impact is important, but they never thought of it as doing it in a systematic way and measuring it, right? So the education part is just very important in the first 2 years. And what we try and do is to kind of institutionalize impact measurement and responsibility within the company, embed it within the governance structures and the documents in the company, so that even after we leave, there is a continuity in impact outcomes that the company will continue to do. So I think increasingly we do that more, and we find that that's very helpful, not just to ensure impact sustainability that it carries on, but also when we sell our businesses, to Paul's point, you actually attract a larger pool of potential buyers, right? And they will actually pay value for companies who do well and do good. So I think education is one, and two, finding ways to embed impact practices into the governance framework. And if you're able to do that, you have a better chance of making sure that even after you exit, the company will continue to do good.
Paul, I heard a 5-year plan, exit strategy in private equity. So how about you? Go ahead.
Well, and again, I'll speak to more the debt side then.
Yep.
On the debt side, it is a harder thing to do, but in the same time, it doesn't mean to say that it's not possible. Simply from the perspective that, obviously, for a lot of our investees, I mean, if you look, the majority of our portfolio has been an investee company of ours for more than 5 years. And this is, and I'm taking financial institutions as an example. If you look at that portfolio, to pick one example, it's one part of our portfolio, the financial institutions debt side. Most of those organizations have been with us for over a cycle of 2 or 3 investments at least. And so these are organizations where they are long-term partners, and where we've been able to work together with them over time, and where we've been able to make them understand that, look, there are certain standards that we expect and that we expect you to apply. So then the question is that if the time comes when they don't need us anymore, and where our financing is no longer required, then that at the same time, we're able to, hopefully, that our approach is something that they will have internalized and that they will take on and will carry on with us. Now, our ability to keep monitoring them after the fact is limited, although there are various databases that still allow us to do that. And on an anecdotal basis, we'll be aware if any organization has made a major shift in its business strategy. But I think our most lasting contribution post-exit is still going to be in terms of the standards and the approaches that we've been able to inculcate over the few years of our investment period. I'm sorry if that's a little bit vague, but the problem is it's hard to kind of come up with a comprehensive idea across all of the many different business models that we cover.
Thank you, Paul. Thank you, Mervyn. We greatly appreciate all the insightful discussion today about impact investing and the best practices. I know it's a lot of topics to cover, and the audience can take away. I took away 2 words, each from one of the gentlemen's: intentionality from responsibility, accessibility from QUADRIA. We hope to see you at your upcoming events as well at AVPN. So next week, on November 17th, we'll host a Deal Share live session showcasing the 5 finalists of the Singtel Future Maker program, focusing on using tech and data to unleash social impact in the areas of aging, health, financial inclusion, and employability. On November 18th, please join us for 2 events: Gender Lens Investing in Practice, a workshop for impact investing professionals, and Insights and Considerations for Investing in Climate Response Water Solutions. Thank you once again for joining us today. I really, really appreciate having one of the smartest gentlemen here helping us dissecting impact investing, measurement, management, and exit. I learned a whole lot today. Until next time, goodbye, everyone. Have a good day. Bye.
Thank you. Bye-bye.